Welcome to the deep dive. Whether you're prepping for a board meeting or maybe trying to make sense of the real estate market or, just someone who loves pulling apart a complex business strategy to see how the gears turn, we have a really fascinating breakdown for you today.
Yeah, this one is definitely a masterclass in strategy.
Totally. Okay, let's unpack this. We are diving into a highly revealing presentation from March of 2026.
Right, from Zillow's chief financial officer.
Exactly, Jeremy Hoffman. And he's presenting to this room full of heavy hitters at an AI investor summit. So our mission today is to uncover how this real estate tech giant took a completely stagnant market and used rigorous financial discipline combined with a very specific AI integration strategy to essentially engineer their own growth out of thin air.
Yeah, and the setting for this presentation is actually critical to understanding its impact.
Yeah.
As the CFO, Hoffman is the numbers guy, right? And he's on stage right after this presenter named Cameron, who had just walked the audience through all these flashy, highly advanced tech demos showing off Zillow's new AI tools.
Oh, wow. So he has to follow the cool demo guy.
Exactly. And he's speaking right before Rich Barton, who is Zillow's co-founder and this legendary tech visionary. So Hoffman is sandwiched between the brilliant developer and the visionary founder.
That's a tough spot to be in.
It really is. His job is to ground the narrative. He has to prove to this room of, skeptical investors that the cool technology they just saw isn't just some shiny, expensive toy. He has to show how it translates into a bulletproof financial reality.
Which sets up the central paradox of this entire presentation. Because to see the scale of what they accomplished, we have to look at the health of the U.S. residential real estate market back in 2025.
Right, which was not great.
No, not at all. Usually when you look at a massive economic sector, it's sort of like watching a heart monitor. You expect a steady, rhythmic beep. And if that monitor flatlines, you'd assume the companies operating in that sector are flatlining alongside it.
Yeah, that's just basic economics.
Right. But by almost every metric, the 2025 housing market barely had a pulse. I mean, it was this frozen, locked-up environment, just heavily constrained by high interest rates, super low inventory. It basically grew at roughly 3% for the entire year.
And a 3% growth rate across an entire sector is essentially stagnation. I mean,
Right.
The traditional causality of business dictates that a stagnant market creates stagnant companies.
Exactly.
They don't expect a massive enterprise to, sprint a marathon when the environment it operates in is on life support. Yet, sitting right in the middle of that flat line, Zillow grew its revenue by 16% year over year.
16%. I mean, that is a 13% outperformance over the broader market, or as they say in finance, 1,300 basis points.
Which is huge.
Right. That's not a rounding error. That represents a fundamental decoupling from the macroeconomic environment. Like if the housing market wave was just this tiny 3% ripple, Zillow didn't just sit on their board waiting for the tide to turn. They had to construct an entirely new business model to generate their own momentum.
Which brings us to the first major phase of Hoffman's strategy, the diversification playbook.
Okay, let's get into it.
So to understand this outperformance, we have to look at how Zillow recognized early on that relying on their traditional model, taking a cut when people buy and sell houses, was a losing game in a frozen market. So they aggressively expanded their borders.
And the aggregate numbers validate that pivot, right?
Completely. Since the start of 2023, their total revenue has grown by 43%.
Wow, 43%. And the fascinating part is where that revenue growth is actually coming from. The twin engines driving this expansion are rentals and mortgages.
Yeah, let's look at rentals first.
Okay, yeah. Since 2022, their rentals revenue is up an astonishing 130%. And they achieved this by, they shifted their focus away from the mom and pop landlord renting out a single basement, and they started heavily targeting massive multifamily apartment complexes.
And the mechanics of that shift are highly strategic. A large property management company with, say, a 500-unit building. That represents stable, recurring advertising revenue.
Oh, that makes sense.
Right. So by building software that integrates directly with the management systems of those massive complexes, Zillow basically made themselves indispensable to the building owners. Back in 2022, they had about 28,000 multifamily properties on their platform. By the end of Q4 in 2025, they had nearly tripled that footprint to over 72,000 properties.
Okay, so they captured the renters, but renters eventually want to buy, which connects directly to that second engine, mortgages.
Exactly. Zillow Home Loans increased its purchase originations by more than 6 times over that same period.
Wait, 6 times the loan volume in a market where nobody was moving.
Yeah, it's wild. And they didn't stop there. They're fundamentally revamping their core for sale and agent products, too. They rolled out features like real-time touring, which allows buyers to instantly book a home tour.
Oh, I've seen that.
Yeah, and enhanced markets, which are driving significantly better conversion rates for the agents using them. Plus, their premium showcase product, which offers interactive floor plans and higher visibility, that's now on nearly 4% of all new listings in the U.S.
Okay, but on top of all that organic product development, Hoffman outlines an aggressive acquisition spree, right?
He does. Over this period, Zillow purchased 4 distinct companies.
Let me guess, they are all over the place.
Well, they bought Follow Up Boss, Spruce, REO, and Virtual Staging AI. Follow Up Boss is really the anchor here. It's a CRM, a customer relationship management tool.
Okay, so what does that actually mean for an agent?
To put it in perspective, an agent wakes up, opens Follow Up Boss, and it dictates their entire day. Who to call, what leads are hot, where their appointments are. And Hoffman notes that this tool is now used by effectively all of their preferred partner agents to manage their daily workflows.
Wait, allow me to step in with a bit of skepticism here. Because if you're an outsider looking at this list, it looks incredibly fragmented.
Tough so.
Well, you have mortgages, you have a massive expansion into multifamily apartment rentals, you buy a closing services company like Spruce to handle legal paperwork, then you buy REO, which handles photography and media, and then Virtual Staging AI, which literally lets an agent take a photo of a depressing empty room and use AI to instantly fill it with digital furniture.
Great, to save on physical staging costs.
Yeah, exactly. But like, is there a risk here of Zillow losing its core identity? I mean, aren't they just throwing spaghetti at the wall to see what sticks?
What's fascinating here is that it only looks like an unfocused scattershot if you view real estate through the old fragmented lens.
Okay, so how should we view it?
If you step back and look at the architecture of what they're building, this is the deliberate construction of a housing super app. The vision is no longer just to be a digital billboard where you browse photos of houses. The strategy is to construct one closed-loop ecosystem.
Ah, I get it. So instead of just being the billboard that advertises the shopping mall, it's like they bought the bank inside the mall for the mortgages, the leasing office for the rentals, and the legal team that writes the leases.
That is a perfect way to visualize it. They are integrating renters, buyers, sellers, and the industry professionals, the agents, loan officers, title coordinators, into a single, seamless digital space.
So they never leave the app.
Right. You find the house on Zillow. The virtual staging helps you visualize living there. You book the tour instantly. You get the loan through Zillow Home Loans. Your agent manages the entire transaction through Follow Up Boss. And the final legal closing is handled by Spruce. The money, the data, and the consumer never actually leave the Zillow ecosystem.
Okay, I see the structural logic there. But building this expansive super app and acquiring 4 distinct companies, that usually triggers a massive explosion in a corporate budget.
You'd think so, yes.
Yet Hoffman reveals a financial metric in this transcript that just defies standard corporate gravity. He says Zillow's earnings are actually growing faster than their revenue.
And achieving earnings growth that outpaces revenue growth is, like, the ultimate goal for any CFO. It proves that the company is becoming fundamentally more efficient as it scales.
So how did they pull that off?
Well, to explain how they managed to buy 4 companies, build an end-to-end ecosystem, and still expand their profit margins, Hoffman dissects their cost structure into 3 distinct buckets.
Right, let's break those down. The first bucket is fixed costs, and this seems to be where the real operational heavy lifting happens. At the end of 2023, Zillow's fixed costs consumed 80% of their revenue, but by the end of 2025, they managed to drive that number down to 64%.
And the context around that reduction is what makes it so impressive. Over that same time frame, the broader economy was dealing with significant inflation, running at roughly 6%.
Oh, right. The macro environment was terrible.
Exactly. Yet, Zillow organically grew their fixed costs at only 5%. So they kept their fixed cost growth below the rate of inflation, all while absorbing the fixed costs, the payroll, the software licenses, the office leases of those 4 new acquisitions.
Wait, how do you mathematically achieve that without destroying the company? I mean, if inflation is pushing all your base costs up and you're adding the overhead of 4 new startups to your balance sheet, reducing your overall fixed cost burden requires more than just like clipping coupons.
Oh, it requires aggressive structural consolidation. When Zillow acquires a company like Spruce or Follow Up Boss, they don't keep the redundant corporate structures.
They gut the redundancies.
Yeah, they integrate the technology and eliminate the duplicate human resources, legal, and administrative departments. Plus, Hoffman highlights that they decrease their own corporate and overhead fixed costs by 5%.
Mostly through real estate consolidation and just letting natural employee attrition happen without rehiring for legacy roles, I'd imagine.
Exactly.
And to translate another major financial move Hoffman mentions, he notes they reduced stock-based compensation by 14% over that period.
Which is huge.
Yeah. For anyone who isn't a Wall Street accountant, reducing stock-based compensation basically means they stopped handing out company shares like candy as part of employee payment packages. By paying out fewer shares, they prevent the dilution of the stock, which fiercely protects the value of the shares for their existing investors.
That reduction in stock-based compensation is a massive signal of financial maturity. But Hoffman makes it clear that they aren't just hoarding the cash they saved from stripping out this overhead. They're ruthlessly taking those savings and pouring them into three specific areas of the business: rentals, mortgages, and crucially, artificial intelligence.
And the AI reinvestment seems to be the linchpin here, because they aren't just cutting costs to make the balance sheet look pretty, right? They're fundamentally replacing human-heavy legacy overhead with AI efficiencies.
Yep.
Like they are spending their saved capital on top-tier AI engineering talent, advanced software solutions for their internal workforce, and massive purchases of computing tokens required to run large-scale AI models. They're changing their operational leverage by replacing expensive, static, fixed costs with highly scalable AI technology.
And that strategic reinvestment flows directly into the second bucket of Hoffman's cost strategy: variable costs.
Okay, what did he say about that?
He's remarkably transparent here. He admits they intentionally spent heavily ahead of their revenue in this variable bucket. They did this to build the infrastructure necessary to support the massive 83% collective growth they experienced in rentals and Zillow home loans.
So they basically allowed the variable costs to spike temporarily just to build the pipes. But he expects those costs to fall back in line with revenue by the second half of 2026.
Exactly. It's a disciplined, forward-looking investment rather than permanent operational bloat.
Right. And then there's the third cost bucket, which is advertising. And it seems like Zillow treats this not as a fixed expense, but as a highly tactical dial.
Yeah, they really dial it up and down.
Like in 2024, they dialed advertising spend up to 9% of revenue to blast out this massive Zillow Has Apartments marketing campaign. Once the awareness was established, they dialed it back down in 2025 to save cash, and they plan to step it back up in 2026 based entirely on where they see strategic market opportunities.
And the financial outputs of carefully manipulating those three buckets are just staggering. Between 2023 and 2025, revenue went up 33%. EBITDA, which is a standard metric for measuring core operating profit, went up 59%.
Wow.
Yeah, and adjusted free cash flow, which is the actual cash left in the bank after the company pays all its necessary capital expenditures, went up 71%.
It is a textbook demonstration of capital allocation and operational leverage. You cut the fat, you protect the stock, you invest in the scalable tech, and your cash flow skyrockets.
Exactly.
But here's where it gets really interesting. We established that they are taking the money saved on corporate overhead and pouring it into AI, right? While Hoffman's transcript gives us a very clear mechanical look at what Zillow's engineers are actually producing with those reinvested dollars.
And it all boils down to unprecedented speed.
Speed. Yes, speed is the ultimate competitive advantage in the technology sector.
Oh, absolutely. And Hoffman provides a staggering internal metric on this. Powered by the internal AI tools they've built and purchased, Zillow is now shipping 40% more code per engineer.
40%.
Yes.
Yeah.
Every single developer on their payroll is producing 40% more functional, shippable software than they were prior to this AI integration.
And he backs that up with a concrete example from earlier in the presentation, right?
It does.
Because the tech demo that Cameron did on stage featured this new tool called Smart Summaries. It's an AI feature that generates instant, highly accurate text message summaries for real estate agents to send to their clients. Hoffman reveals that Zillow's engineering team took that feature from a raw, whiteboard concept to a fully launched, production-ready product in less than a week.
Which is crazy. Launching a production-ready feature in under a week inside a publicly traded company operating in a highly regulated industry like real estate, that's almost unheard of.
It totally redefines corporate agility. Like
Mhm.
a multi-billion-dollar legacy tech brand is usually structured like a massive, heavy assembly line. It takes months of planning and retooling just to change one part of the product. But Zillow has essentially retrofitted their traditional assembly line with a highly responsive, automated nervous system. It's like turning a massive corporate cruise ship into a fleet of agile speedboats.
I love that analogy.
They're operating with the speed of a garage startup, but with the distribution of a titan.
We really have to contextualize why shipping 40% more code actually matters, though, beyond just being an impressive vanity metric.
Okay, why is it so crucial?
It is the direct mechanism they are using to out-innovate the market dislocation we discussed at the beginning. When the housing market is completely frozen, no one is moving. The only way to grow your revenue is to aggressively steal market share from your competitors by offering significantly superior tools.
Which perfectly explains their massive stock buyback program. In the first quarter of 2026 alone, Zillow repurchased over $625 million of their own stock.
Yeah, that's a massive bet.
A company only executes a buyback of that magnitude when the leadership looks at the landscape and decides that their own stock is the single best investment available. They are fundamentally betting hundreds of millions of dollars on their own velocity.
Right. But despite this financial discipline and speed, Hoffman recognizes that the broader investment community has harbored significant doubts about Zillow over the last 3 years.
Oh, sure, the skeptics.
Yeah, and he spends a crucial segment of the presentation addressing what he calls the 5 key debates. These are the existential threats that skeptics argued would eventually dismantle the company.
It's a very assertive move for a CFO to literally put the bear cases up on a slide and dismantle them in front of investors.
It really is.
Let's run through the first 4 quickly to set up the finale because the last one is the big one. So debate number 1 was the widespread fear that buy-side agent commissions were going to rapidly decline across the industry, taking Zillow's revenue down with them.
Right. But Hoffman argues that Zillow's preferred partner agents weren't damaged because high-quality, independent representation maintained its value in complex transactions. Basically, the best agents adapted to the new rules, and Zillow's model is built exclusively around the best agents.
Got it. Okay, debate number 2 was the persistent fear of a giant competitor entering the real estate space and simply outspending Zillow into oblivion.
And Hoffman counters that by pointing to the scoreboard. Zillow's brand strength increased. They added $638 million in new revenues since 2023, and they established complete dominance in the multifamily rental space while the competitors struggled.
Yeah, the scoreboard doesn't lie. Debate number 3 was the threat of fragmented listings. You know, the idea that local brokerages would hide their listings behind private walled gardens, starting Zillow of inventory.
But Hoffman notes that Zillow stayed flexible and consumer-focused. They launched features like Zillow Preview just a week before the summit, ensuring they can seamlessly connect consumers to inventory wherever it resides.
Right. And then debate number 4 revolves around the legal and regulatory threats that just constantly plague the real estate industry.
And the high-profile example there was the lawsuit filed by Compass. Hoffman essentially spikes the football on this one. He informs the audience that Compass abandoned its lawsuit just the week prior, after a federal judge ruled that their core arguments had absolutely no merit.
Wow, just the week before.
Yeah. Zillow navigated the legal gauntlet by ensuring their product development consistently put the end consumer first, which is a really strong defense in antitrust and competition law.
Which brings us to debate number 5, the main event of the summit. This is the existential question that hangs over the head of practically every single technology company operating today. Will horizontal, general-purpose, large language models like ChatGPT or Claude make vertical, industry-specific internet marketplaces like Zillow completely obsolete?
If we connect this to the bigger picture, this is the question you have to ask if you're evaluating any tech company right now.
Because, I mean, why wouldn't a super smart general AI eventually just bypass the Zillow Super app entirely? Like, if an AI has read the entire internet, why can't I just open my phone and say, find me a 3-bedroom house in Austin, Texas, and connect me directly with the seller to negotiate? Why do I need to enter the Zillow ecosystem at all?
Hoffman's thesis is that AI is actually a massive accelerator for Zillow, not a disruptor, because of the fundamental limitations of general AI.
What are those limitations?
Well, a general-purpose large language model is trained on the public internet. It is incredibly smart, and it knows a little bit about everything, but it relies entirely on publicly accessible information.
Ah, okay, I see the structural advantage here. A general AI doesn't know which specific basement in Austin flooded during a storm last week, because that isn't on Wikipedia.
Exactly.
It doesn't know which specific neighborhood has an unannounced zoning change pending at the city council tomorrow. Zillow possesses the proprietary hyperlocal data.
Exactly. The proprietary data is the ultimate moat. Furthermore, an LLM sitting on a server somewhere does not possess a trusted, vetted network of physical, human real estate agents operating on the ground in every zip code.
Right, it doesn't have people.
And it doesn't own Follow-Up Boss, which is directly hardwired into the daily workflows of the top-performing real estate professionals in the country. And most importantly, an LLM does not have the built-in habitual audience of millions of highly engaged consumers who already associate the Zillow brand with housing.
Okay, so Zillow isn't trying to build a new AI from scratch to fight the tech giants, and they aren't hiding from general AI either. They're taking their incredibly deep, highly specific, proprietary vertical data, and they are feeding it into these advanced models to create this inescapable competitive advantage.
Exactly. A general AI cannot compete in real estate because it simply does not have access to the raw ingredients that Zillow has been stockpiling for over a decade. They have the distribution, the proprietary local data, and the professional networks. AI just makes leveraging all of that radically faster and more efficient.
So, what does this all mean? When you synthesize all of this, the cost discipline, the super app integration, the AI engineering speed, and the proprietary data moat, the incredibly bullish financial targets Hoffman lays out at the end of the presentation make complete sense.
I do. And he benchmarks Zillow against its peer group, which is consumer internet companies operating in the $10 billion to $50 billion market cap range.
And the contrast is striking, isn't it? The median revenue growth expected for those peer companies is 29%, but Zillow expects 34%. The median EBITDA growth, that core operating profit for the peers, is 34%. Zillow is projecting a massive 56% growth.
Yeah, and while the median peer company is expected to see their stock-based compensation remain flat, essentially continuing to dilute their shareholders, Zillow expects their stock-based compensation to drop by another 22%.
Hoffman concludes by reiterating Zillow's mid-cycle financial goals, which remain entirely unchanged despite the terrible macro environment. They're still aiming for $5 billion in total revenue and a 45% EBITDA margin. But he adds a brand new, highly significant target to the board, a 25% net income margin.
And announcing a net income margin target of 25% is like the ultimate flex for a CFO.
Oh, for sure.
It proves that Zillow is no longer just chasing top-line growth at all costs. They have supreme confidence in their trajectory toward actual sustainable GAAP profitability. It is the final evolution from a growth stage tech startup into a mature, highly profitable corporate giant.
So whether you are an investor analyzing structural market trends, a tech enthusiast watching how legacy companies adapt to the AI arms race, or just someone listening to this who might want to rent a new apartment next year, this transcript really is a masterclass. It demonstrates precisely how a leadership team can use strict, almost ruthless financial discipline to fund an internal technological revolution, completely decoupling their fate from a stagnant, frozen macroeconomic environment.
It really is a phenomenal case study in execution and operational leverage.
Yeah.
But as we wrap up this analysis, Hoffman's presentation raises an important, deeply philosophical question that isn't explicitly answered in his financial models, but it kind of lingers right beneath the surface of everything Zillow is building.
Ooh, okay. What's the hidden question?
Well, if Zillow's internal AI makes their engineers 40% faster, and if this integrated super app successfully removes all the friction from buying, selling, and renting, what eventually happens to the human element of real estate? If a highly advanced AI model can match you perfectly to a home based on your exact behavioral data, secure your mortgage approval in real time, and generate all the bespoke legal closing documents in a matter of seconds, does buying a house eventually become as frictionless and perhaps as emotionally detached as ordering a ride-share on your phone?
Wow. That concept changes the entire definition of what a home purchase feels like. We started this deep dive talking about a heart monitor, looking for a pulse in a frozen, stagnant market. And Zillow definitely found the pulse, and they engineered it to beat faster and stronger than ever before. But you really have to wonder if, eventually, the digital ecosystem becomes so perfectly efficient and so heavily automated that the human heartbeat gets engineered right out of the transaction entirely. Definitely something for you to mull over the next time you find yourself endlessly scrolling through digital listings on your phone. Well, thank you for joining us as we unpacked this incredible strategic pivot, Keep digging into the sources, keep questioning the mechanics behind the business, and we'll catch you on the next deep dive.